Welcome back to the deep dive. Today, we're tackling something that every single founder, freelancer, or even just someone with a side hustle has to face. It's that decision that really, truly determines your financial fate. Choosing the right business entity structure. Okay, so let's unpack this. I think for too long, people have seen filing paperwork for, say, an LLC or a corporation as just this bureaucratic hurdle, something your lawyer or your CPA just handles for you.
Right. A box to check.
Exactly.
Yeah.
But our source material makes it incredibly clear that this choice, it's not some dusty legal formality. It is, first and foremost, a foundational tax strategy. Get this wrong, and you could be signing up to pay thousands, maybe even tens of thousands, more in tax than you have to, year after year.
That's the core misunderstanding we're really trying to address today. Our mission here is to move beyond just what's popular or what's convenient. We're looking for the optimal structure, the one that maximizes your cash flow, protects your personal wealth, and, perfectly aligns with where you want your business to be in 5 years.
To do that, we've kind of developed a toolkit for you, the listener, based on 4 core variables we're going to analyze for every single entity.
Yeah, think of these as the metrics for your blueprint.
First, and this is usually the biggest driver for change, is taxes. And we have to look past just the individual income tax rate. The real killer, the one we're going to be a little obsessed with today, is that crushing 15.3% self-employment tax.
That's the big one. Then second, we're going to examine asset protection. You'll also hear this called liability. The key question is, does the entity create a wall between a creditor or a lawsuit and your personal assets? Your home, your savings, your car.
Right. That separation is the whole reason many entrepreneurs make the leap from a simple structure to a corporate one in the first place.
It is.
Okay, third, and this is absolutely vital for anyone with big growth ambitions, is fundraising ability. I mean, if your goal is to grow fast, attract venture capital, or maybe even go public someday, your choice of entity today dictates who can invest in you tomorrow.
And we'll see how massive investors like foreign funds or NGOs have some very specific and pretty much non-negotiable preferences on this.
And finally, number 4, compliance.
Yeah, we have to be realistic about the administrative burden here. We're talking about required bookkeeping, setting up and actually running payroll, annual state reporting, all those corporate formalities.
And every single increase in compliance adds cost, right?
Yeah.
Either in your time or in accountant fees.
Exactly.
And here's the essential thread that we're going to be weaving through this entire deep dive. This choice is not permanent. Businesses rarely just stand still.
That's right. Our sources identify a really clear evolutionary path that most successful businesses follow. You might start out as a sole proprietorship for, maximum simplicity.
Just to get going.
Just to get going. Then, as you start to accumulate assets, the immediate next step is usually switching to an LLC for that asset protection. Then, when the business gets really profitable, the smart move is often migrating to an S-corporation to get those major self-employment tax savings. And then finally, if your business model demands huge outside investment, the ultimate evolution is the C-corporation for fundraising and just massive scaling.
So understanding this progression.
Yeah.
That's the key to smart strategic planning from day one.
All right, let's start at the very beginning. The absolute lowest rung of formality, the sole proprietorship. This structure, which is often the accidental starting point for every freelancer out there, is defined by one fundamental concept. The owner is the business. There is zero legal separation.
And that lack of separation, just as you said, is both its greatest strength and its greatest weakness. On the strength side, it's just incredibly simple, fast, inexpensive to get going.
Yeah, if you're a freelance graphic designer or you drive for a ride-sharing service, you are already operating as a sole proprietor.
You are. You literally just start working. There's no corporation paperwork to file. You just use your social security number as your tax ID, and you're in business. And if you want to use a name other than your own, say gourmet dog treats, you just file a DBA. Doing business as with your state.
Which can take 5 minutes and cost, less than $50? It's incredibly simple.
And that simplicity carries over to taxes, too.
It does. It's what we call a flow-through entity. The business doesn't file its own separate tax return. You just report all your income and expenses on a Schedule C, which is just a part of your individual Form 1040. It's as simple as it gets.
Plus, you have absolute control. No board of directors, no partners, no shareholders. You call all the shots, which is great for being agile in the beginning.
However, and this is a big however, we have to pivot to the cons.
Yep.
And they are so severe that they almost guarantee an entrepreneur will eventually leave this structure behind. The primary risk is the complete lack of liability protection.
Okay, we need to spend some time on this because this is the existential threat of the sole proprietorship.
Hmm.
When we say the owner is personally liable, what exactly are we exposing?
Everything, your entire personal financial world. Everything. If your business takes out a big loan, let's say to buy a fleet of delivery vans or some real estate, and then the business can't pay it back, well, the creditor isn't limited to seizing those vans.
Mm-hmm.
They can legally come after your personal home, your retirement savings, your private investment accounts, even your spouse's wages in some cases.
Wow. So that's a huge vulnerability that just grows and grows the minute you buy your first home or build up a little nest egg.
It is. And the exposure isn't just about debt, it's also about lawsuits. Say you run a consulting business and a client sues you for gross negligence. That lawsuit isn't targeting your business, it's targeting you personally.
There's no firewall.
There is no firewall.
Yeah.
Your business is completely tied to your personal balance sheet.
Okay, so beyond that massive liability risk, let's circle back to the tax problem we mentioned at the top, the self-employment tax.
Right. This is the financial disadvantage that really accelerates the need for change as your income starts to grow.
How does it work exactly?
Okay, so that 15.3% self-employment tax is applied to every single dollar of net profit you earn through the sole proprietorship. This tax covers Social Security and Medicare. In a normal job, this is split between you and your employer.
Right, I pay 7.65% and my company pays the other 7.65%.
Exactly, but as a sole proprietor, you're both the employer and the employee, so you pay the whole 15.3% yourself.
And that's on top of your regular income tax.
On top of everything else.
Let's do the math on that just to make it real for everyone listening. If you net, say, $100,000 in your consulting business this year.
Well, $15,300 of that is immediately gone, earmarked for self-employment tax.
Before you even calculate your federal and state income tax brackets.
Before anything, that is a massive chunk of your profit to lose right off the top. It completely changes your margins.
And the final nail in the coffin, fundraising.
Oh yeah, it's a non-starter. Our sources all confirm it's basically impossible to raise money this way. VCs, angel investors, even banks doing complex loans, they need a separate incorporated entity. You're limited entirely to your own cash.
So, to sum it up, the SP is great for the absolute start. The freelancer, the gig worker who just wants simplicity. But the second you have assets to protect, or you start hitting any kind of real profitability, the risks and the tax costs they just completely outweigh the administrative ease.
It's the first entity you have to evolve away from. Which brings us to the partnership. This is the natural next step when a business needs shared skills or, capital from two or more people.
So by definition, it's just a business owned by multiple people sharing profits and losses.
Right. And as you noted earlier, it's often formed by accident.
You don't actually have to sign a formal document to create one, do you?
That's a critical legal point. If two people just agree to buy an investment property together or start a joint business, they have likely created a general partnership in the eyes of the law.
Even with just a handshake.
Even with a handshake, which is why formality is so important here.
To operate formally, though, and to file your taxes, you have to get an employer identification number, an EIN, from the IRS.
Right, you move away from using your personal Social Security numbers. And if you do nothing else, you absolutely must draft a robust partnership agreement. We cannot stress this enough.
The bedrock of the relationship.
Absolutely. The sources all highlight this. It needs to define everything. Contributions, how income and losses are split, what happens if a partner wants to leave or dies, who handles the tax filings.
Because without it, the smallest disagreement can just blow up the whole business.
Instantly. Yeah.
From a tax perspective, it's still a flow-through entity, so it's pretty low admin compared to a corporation.
That's right. The partnership itself files an informational tax return, that's Form 1065, but the profits and losses flow through to the partner's personal returns.
And early on, if the business is losing money, that can actually be a benefit for the partners, right?
Yeah.
They can deduct those losses.
It can be. But this brings us to a really technical but profoundly important concept for partners. There's a limit on how many losses you can deduct. It all comes down to what tax pros call inside and outside basis.
Okay, wait. Before we get into the weeds with numbers, let's find an analogy for this. This sounds like one of those things nobody thinks about until they have a huge loss. What is basis in simple terms?
Okay, that's a great idea. Think of your basis as like the spending limit on a debit card.
Okay.
It's the total amount you are allowed to spend, or in this case, the maximum amount of losses you're allowed to deduct before you run out of funds.
So you can only deduct what you've put in. It's your skin in the game.
Exactly. It's your initial cash contribution plus any subsequent debt you're on the hook for, plus any profits that have been allocated to you over the years that you haven't taken out.
Okay, I think I've got it. So let's apply that to this scenario from our sources.
All right. Let's say partner A initially invested $10,000. In the first few years, the partnership did well, and another $9,000 in income was allocated to them. So their basis is now $19,000.
That's their debit card limit.
That's their limit. The next year, the business struggles. It has a massive $100,000 loss, and 90% of that, so $90,000, is allocated to partner A.
But they can only deduct.
They can only deduct $19,000 on their personal tax return that year.
They're limited by their basis.
Correct. So that remaining $71,000 of loss, it isn't gone forever, but they can't use it now. It just gets carried over.
It becomes what's called an unallowed loss.
An unallowed loss, just waiting until they can rebuild their basis, usually by putting in more cash or earning future profits. This is why tracking your basis is absolutely critical for anyone in a partnership.
Wow. Okay. That detail really shows why even these simple flow-through structures can get complex fast. Now, what about the cons? I'm guessing they look pretty similar to the sole proprietorship.
They do. First, that liability problem is still there. General partnerships offer no liability protection. All partners are personally on the hook for business debts.
And it can be even worse, right? Because one partner can make a decision that makes the other partners liable.
Exactly. You're financially tied to the mistakes of your partners. And second, the tax drawback is still there. All that income is still subject to the full 15.3% self-employment tax.
So no relief there.
No relief. And finally, there's that cash flow risk. You pay tax on the income allocated to you, even if the partnership keeps all the cash to reinvest.
So you could have a huge tax bill with no actual cash from the business to pay it with.
That happens all the time.
So the partnership is good for those early stage ventures that need shared skills. A family business, two friends starting a consultancy. But just like the SP, that lack of a liability shield and the tax burden, they become huge motivators to evolve.
All right, so if the SP and partnership are defined by a lack of separation, the C corporation is the complete opposite. It's defined by ultimate separation.
That's a great way to put it. A C-Corp is a completely separate legal entity, a true person under the law, and that changes everything.
So two big things happen that we haven't seen yet.
Right. First, the owners, we call them shareholders now, they have limited liability, their personal wealth is protected. And second, the corporation pays its own taxes directly.
And this gets us to the big C-Corp tax advantage, that flat 21% corporate rate. What's the benefit there? Well, that 21% rate is a powerful tool for any business focused on growth. For comparison, a successful founder could easily be in a personal tax bracket over 35%. By keeping the profit inside the C-Corp, you're taxing it at a much lower rate.
I see. So the goal isn't necessarily about paying less total tax over a lifetime, but about maximizing the cash available inside the company for reinvestment right now.
Precisely. If you're a high-growth tech company, you want every single dollar going back into R&D, hiring, scaling, not distributed to owners who would then pay high personal tax rates on it. The C-Corp is a growth vehicle.
But the real undeniable superpower of the C-Corp is its fundraising power. This is the structure you need if you want to play in the big leagues of venture capital.
It is non-negotiable. The C-Corp structure allows for incredible flexibility with equity. You can issue unlimited shares, create different classes of stock, preferred stock, common stock.
Different voting rights, different payout preferences, all the complex stuff that VCs need to structure a deal.
Exactly. And a lot of this preference is driven by the tax needs of the investors themselves.
Right, let's get into why those big institutional investors, foreign entities, NGOs, pension funds, why they absolutely demand a C-Corp.
It all comes down to the complications of flow-through taxation. If a foreign investor or a big tax-exempt entity like a U.S. pension fund invests in an LLC, the income from that business flows through to them.
And for the foreign investor, that means they might have to file a complicated U.S. individual tax return.
Which they will do anything to avoid. And for the tax-exempt entities like a university endowment,
that income flows through as something called unrelated business taxable income, or UBTI.
Right. And as the name implies, these entities are supposed to be tax exempt. But if they receive UBTI, they suddenly have to pay tax on that income, which totally defeats the purpose of their tax-exempt status.
So a C-Corp solves this. How?
The C-Corp acts as a perfect tax shield for them. The corporation pays the tax internally on its Form 1120. The income never flows through to the shareholder.
It just gives them a dividend or hopefully stock appreciation.
Exactly. And it eliminates their need to file a U.S. tax return or worry about UBTI. It simplifies their compliance dramatically.
So it's the only viable choice for a major capital raise. Plus, you get easier transfer of ownership to shares and that flexibility with your fiscal year.
All huge benefits for scaling.
Okay, this all sounds amazing. Low corporate tax rate, liability protection, infinite fundraising potential. But now, the elephant in the room, the massive trade-off.
Double taxation.
Double taxation.
It's the infamous penalty of the C-Corp structure. And it's critical to understand where those two layers of tax land.
Okay, layer one. The corporation makes $1 million in profit. It pays the 21% corporate tax rate on it.
So after tax, it has $790,000 left.
Now, layer two. The corporation decides to distribute that remaining $790,000 to its shareholders as a dividend.
And now the shareholders have to pay tax on that dividend again on their personal income tax returns.
So the exact same dollar of profit gets taxed once at the corporate level and then again at the individual level.
Which can significantly reduce the final return for the owner. And this is why C-Corp are just not practical for most small businesses. The compliance is a headache: formal incorporation, stock issuance, board meetings, minutes.
It's just overkill if all you need is liability protection.
Total overkill.
Okay, so the C-Corp brought us liability protection, but also the curse of double taxation. The S-Corporation, though, it was designed to kind of cherry-pick the best of both worlds.
That's the perfect way to describe it. The S-Corp is often the ideal structure for an actively managed, profitable small business. It combines the limited liability protection of a C-Corp with the flow-through taxation of a partnership.
So, liability shield, check. And the corporation itself pays zero tax, so the shareholders only pay once on their personal return.
Yes, and that avoids double taxation. But the true genius of the S-Corp is how it deals with that 15.3% self-employment tax.
This is the big tax saving strategy, and it all revolves around this idea of reasonable compensation.
Let's really dedicate some time to this, because this is the financial strategy that motivates thousands of businesses to become S-Corp.
So what is reasonable compensation?
Okay. If an owner is actively working in their S-Corp and generating income, the IRS requires that owner to take a salary, a reasonable compensation that's in line with the industry standard for the job they're doing.
And the payroll tax, that 15.3%, is paid only on that salary amount.
Only on the salary. And here's the magic. Any income that's left above that reasonable salary can be distributed to the owner as a distribution.
And those distributions are not subject to the 15.3% self-employment tax.
Correct. They're still subject to income tax, but they escape that big payroll tax hit.
Okay, let's run that example again to see the savings. We have a profitable service provider, a CPA, a lawyer, netting $150,000 a year.
As a sole proprietor, they'd pay 15.3% on the full $150,000. That's about $23,000 in self-employment tax. A huge number.
But if they operate as an S-Corp, they do some research and determine that, say, $70,000 is a reasonable salary for a CPA in their city.
Right. So they pay payroll tax on that $70,000 salary. The remaining $80,000 is taken as a tax-free, well, a payroll tax-free distribution.
So they've shielded $80,000 of income from the 15.3% tax.
Which represents a tax saving of over $12,000 every single year. That's powerful.
So this is tailor-made for those high-earning service businesses.
It is, but that benefit comes with compliance complexity. You have to set up and run a formal payroll system, which is not simple.
And you can bet the IRS is watching that reasonable compensation number very, very closely. They know the game.
They do. If you get audited, you have to be able to prove your salary was reasonable. You need data, salary surveys, documentation of your duties.
Because if you undershoot it, they can just reclassify your distributions as wages and send you a big tax bill.
With penalties. Exactly. And beyond compliance, the S-Corp has some strict limitations. You can only have a maximum of 100 shareholders.
And critically, you can only issue one class of stock, which, as we just discussed, makes it impossible for venture capital.
A total non-starter for VCs. And finally, there are shareholder restrictions. Foreign investors can't be shareholders. Neither can partnerships or other corporations.
So it kills any chance of attracting international capital.
It does.
So the S-Corp is the gold standard for profitable, U.S.-based service businesses. Your doctors, consultants, developers making, say, 60 grand up to a few $100,000. It's not built for explosive growth, and it's not built for passive asset holding. Which brings us to our last major structure, the limited liability company, or LLC. If the S-Corp is a tax hybrid, the LLC is the ultimate organizational chameleon.
It really is. It gives you that liability protection, but with immense flexibility on how you're taxed. You create it by filing articles of organization with your state.
And the foundational pillar is right there in the name, limited liability.
Exactly. Just like a corporation, it creates that legal wall between the business's debts and your personal assets. That alone is why most people form one.
But the really fascinating and often confusing part is its tax flexibility, what you called its identity crisis.
Right. Legally, it's an LLC. But for tax purposes, it can choose to be almost anything else.
So by default, its tax identity is based on the number of owners.
It is. If you're a single-member LLC, the IRS treats you as a sole proprietor by default. You file on the Schedule C. If you have 2 or more members, the IRS treats you as a partnership by default. You file a Form 1065.
But that's just the default. The LLC can elect to be taxed differently.
Yes, this is the key. By filing a form with the IRS, that LLC can choose to be taxed as an S-corporation or even as a C-corporation.
So if I see Jane Doe's Consulting LLC on a tax return, that tells me almost nothing about how Jane is actually being taxed.
Nothing. You have to dig deeper. Did she make an S-corp election? If so, she's dealing with payroll and reasonable compensation. If not, she's being taxed as a sole proprietor and paying that full 15.3% self-employment tax.
A massive difference.
Huge. And operationally, the LLC is incredibly flexible. The ownership rules are defined in an operating agreement, and unlike an S-corp, there are basically no restrictions on who can be a member.
Foreigners, other corporations, trusts,
Yep.
they can all be members.
Yep. Which avoids all those S-corp headaches. But despite all that flexibility, the LLC isn't perfect. It has its disadvantages, especially if you stick with that default tax status.
Let me guess. The self-employment tax is back.
It's back. If you're an active member of an LLC and it's being taxed as a sole proprietor or partnership, you're still paying the full 15.3% on all your income.
So the LLC itself doesn't solve the tax problem. You have to take that extra step and elect to be taxed as an S-corp to get those savings.
That's the only way. Beyond tax, there are also some state-level quirks. The fees can be surprisingly high.
And the prime example is California.
California. Our sources highlight that California requires a minimum annual tax fee of $800 for any LLC registered there.
Regardless of whether the business makes any money.
Regardless, even if it makes $0.
Well, if I start a little side hustle in California as an LLC, and I only make $500 my first year, I still owe the state $800.
You do, which instantly puts you at a loss. For small businesses just getting started, that $800 fee is a huge barrier and a good reason to maybe stay as sole proprietor for a little while longer.
And what about fundraising? We said VCs prefer Inc. over LLC.
They do. It's really about perception and predictability. To a VC, LLC can signal ambiguity, complex agreements, weird profit splits. They just prefer the clean, standard framework that a C-Corp guarantees. There is one area, however, where the LLC is totally dominant, and that is passive investment, especially real estate.
Okay. Let's walk through the logic here for a real estate investor. They definitely need liability protection.
Absolutely. A tenant lawsuit, a construction dispute that immediately rules out the SP and the partnership.
So they're choosing between a C-Corp, an S-Corp, and an LLC. Why is the C-Corp a bad fit?
Double taxation on the cash flow. If they want to pull that rental income out to live on, they don't want it taxed once at the corporate level and then again when they take it as a dividend.
Makes sense. Okay, so what about the S-Corp? Why is that a bad fit for passive real estate?
Because the income from rentals is passive income. It's not active labor. And the S-Corp requires the owner to take a mandatory salary, that reasonable compensation. But if you're just passively managing investments, issuing yourself a salary is, well, it's impossible. It makes no sense.
The S-Corp is designed to save payroll tax on labor.
And this isn't labor, so that leaves the LLC. It provides the critical liability protection without the corporate tax rates or the nonsensical salary mandate.
So the investor can just form a single-member LLC or a partnership LLC, get the asset protection, and keep that simple flow-through taxation.
It is purpose-built for holding assets.
Okay, now that we've broken down each structure, let's pull it all together. Choosing the right entity is really about aligning your structure with your core goals.
Let's run through our scorecard again based on those 4 variables.
First, if your main goal is just liability protection, period.
Then you have to move beyond the SP and partnership. Your choices are the LLC, the S-Corp, or the C-Corp.
Okay, if your goal is pass-through tax and no double taxation.
Then you're looking at the SP, the partnership, the default LLC, and the S-Corp. The C-Corp is the only one that stands alone with that double tax risk.
Now, for that very specific goal of avoiding the 15.3% self-employment tax on your active income.
There is only one truly effective strategy, the S-Corp, applied specifically to those distributions above your salary. Every other default structure hits you with the full 15.3%.
And finally, if your long-term vision is fundraising and attracting VC capital.
The C-Corp is mandatory. It's the only one that provides the stock flexibility and the institutional tax shielding that serious investors require.
All right, let's use 3 quick scenarios to really solidify this for you, the listener.
Sounds good. Scenario 1, VC venture startup. A software company, 2 founders, breakthrough AI model. They need to raise $5 million in the next year, and they anticipate foreign investors.
The answer has to be C Corporation, no question.
Absolutely definitive. The goal is capital. They need multiple classes of stock, especially preferred stock, and they need to accommodate foreign investors who can't be S-Corp shareholders. Any other choice shuts down their fundraising before it starts.
Okay. Scenario 2. Solo CPA, making $120,000.
Yeah.
Currently a sole proprietor, all active service income. They want a liability shield, but are mostly focused on maximizing their take-home pay.
This is the perfect S-corporation candidate. Right now, they're facing a self-employment tax bill of over $18,000 a year. By switching to an LLC and electing S-Corp status, they get that liability shield, and more importantly, they unlock those tax savings.
So they set a reasonable salary of, say, $50,000, pay the 15.3% on that, but they take the other $70,000 as a distribution.
Saving them over $10,000 a year, that easily justifies the cost and hassle of running payroll. The key variable is tax minimization on active income. S-Corp is the answer.
Final one. Scenario 3. Real estate investment portfolio. An investor managing 8 rental units. Steady passive cash flow. They need protection from lawsuits, but want simplicity.
The answer here is the LLC. The need for liability protection is paramount, so SP and partnership are out.
C-Corp is out because of double taxation on the cash flow they want to take out.
Correct. And the S-Corp is out because the income is passive. You can't issue a mandatory salary on passive rental income.
So the LLC, taxed as a default partnership, or SP, gives them the liability protection without any of the other baggage.
It's the only one that respects the passive nature of the income while still shielding their assets.
So what this deep dive really clarifies is that choosing a business entity it's a fundamental strategic decision. It is not just a box to tick on a form. It dictates your liability, your tax burden, and really the ceiling on your long-term growth.
And we've shown that no single entity is universally perfect. The best choice depends entirely on where you are on that evolutionary path. It depends on the nature of your income active labor versus passive assets and what your ultimate goals are.
And understanding that progression, from the simplicity of the SP to the liability shield of the LLC, to the tax-saving S-Corp, and finally the scaling power of the C-Corp. That's the knowledge that lets you grow your business and protect your wealth at the same time.
And that strategic thinking leads us to our final provocative thought for you to take away. We focused a lot on current tax optimization, but let's think about the long-term consequences of asset accumulation. Say you chose a C-Corp today for its low 21% tax rate. You're retaining a lot of cash inside that company. But what happens years from now when you want to convert that C-Corp into an S-Corp or maybe sell the business and liquidate those built-up assets? The source material mentions some serious potential complications. Things like an accumulated earnings tax in C-Corp or really complex tax events when you try to convert from a C-Corp to an S-Corp later on. We're talking about massive hidden tax bombs that could be triggered when you sell. For instance, creating a huge corporate-level gain on assets that have appreciated in value over decades.
So what hidden tax problems might you be setting for your future self? If the entity you choose today doesn't align with how you plan to eventually sell or pass on your business.
That's something to mull over as you plan the future of your financial foundation.